But in the meantime, we just wanted to give some background on what our firm does and what opportunities exist for any of you that potentially would want to consider joining our firm. So Mike and Jason is my director. Mike is an advisor there as well.
Yeah. Well, hey, thanks for coming. Out of all the groups I've spoken to, the last bunch of years, you guys are by far the most recent. So, really appreciate your time. So we just wanted to kind of start and just talk about kind of financial planning 101 and hit the areas of questions or concerns that you guys had that would kind of help direct, I guess, what Jason and I we'll bring to the table. So I guess when you think of financial planning, like what are you immediately like, oh my goodness, I wish I knew about blank, or what were you hoping to learn more about tonight?
So specifically when you're looking at someone's risk tolerance and time horizon, like based on what their allocation is, like how far in the future they want to have their financial goals or how risky they want, how do you determine then, how do you go about determining which kind of financial instrument you go about, recommending to them?
Yeah, great. So this is my the investor profile. So before we could even make any kind of recommendation as far as any investment, retirement planning, or whatever, we would just have to take kind of an 11 question quiz, essentially, just a profile. And this is my pumpkin pie theory, right? Any chefs in the room? All right. So like if I say, what was your name again?
Sean.
Sean. Hey Sean. So hey Sean, you're bringing pumpkin pie to Thanksgiving, right? You look up a recipe, you're happy with that. Then you realize you're shuffling through tons of recipes. You realize there's a million different ways to make a pumpkin pie.
Yeah.
Right. So we basically come up with a correct asset allocation for you. Are you conservative? Are you balanced? Are you aggressive? Are you very aggressive?
Mm-hmm.
So then Northwestern follows a research-backed asset allocation method. It's called the efficient frontier. Not sure if you're familiar with that. So basically, in the same way that you can find a million different recipes for one pumpkin pie, there's a million different ways you can be conservative. There's a million different ways you can be aggressive, or build, let's say, an 80-20 portfolio.
Yeah.
So we would just kind of follow as close as possible to our research-backed methodology, and that's really the key to investing, right? It's not even necessarily how much you're putting in, or obviously it's what you're putting in. Really, it's determining your mix of how much risk do you want to be taking versus your more conservative things down there. What's nice is, how old are you right now?
20.
20. So your asset allocation as a 20-year-old is going to obviously change down the road as a 45-year-old, as a 65-year-old, right? So it's not a once-and-a-done thing. That's what's cool about Northwestern. We're in this for the long-term relationships with clients, helping people figure out their asset allocation consistently throughout their lifetime.
And do you make insurance recommendations as well? Because I was talking to a financial planner, and they do both insurance and others, like the regular investment
planning.
And so his concern was when he was talking to people that just do investments or just insurance, the people that are just doing insurance and they start recommending investments, that's taking money out of the insurance people's trailing fee, and they're not necessarily going to make as high a premium on their monthly payments, whereas you're going to the investments, that's less assets under management if he's recommending someone paying their premium every month for an insurance plan. So you recommend both, or you mostly just go with investment?
So Northwestern Mutual is a comprehensive financial planning company. So we will show you how your insurance, we call it risk management, right? Making sure that you, your family, the people you love are protected financially in case something happens to you physically. And in fact, we're committed to solving risk management problems first, because it doesn't really do a whole ton of good to put all your eggs in the investment basket, and then you get hurt, you're not working, which means you're not saving, which means you're not going to be able to hit any of your investment goals, right? Yeah. So then we work with you and show you how your insurance and your investments can work together, right? So we do both.
So how did you get started in Northwestern Mutual, and then what made you want to do wealth management?
Yeah, so for me, it all really starts, it started with my wife and me becoming clients, right? So we were actually clients of Northwestern years ago before, before I became an advisor. And so that was through just a buddy from church recommended that I talk to my advisor. So he called me. He's like, hey, do you know any decent people that are having kids? My wife and I were having kids, and we became clients that way. And then I had an education background, so I always wanted to find something where I could help people, right? Make an immediate impact. Because when you're teaching, the impact of what you're doing with your students doesn't really show up. It might be like 5-10 years down the line when they write you an email or write you a letter and they say, hey, Mr. Lennon, thank you so much for what you did. You never know. But in this case, I mean, my goodness, if you're able to put some risk management stuff in place for people or help people solve their investment planning needs, it's an immediate setup for helping people out. So that's always what I wanted to do. So. And then that guy, my advisor, is kind enough to introduce me to Jason's office here out in Center Valley. Yeah.
What major were you in college?
Say again. So I was actually in the humanities side of life. So I was actually I was working in Spanish language teaching and then history, English literature, which is kind of perfect, right? Because I've always been a people person and an ideas person. So for me, it's a privilege to be able to break down insurance and investment, sometimes which are hard to understand topics or potentially complex, breaking it down for people to understand. And then that way, if you and I never speak to each other again, you'll still have been better off for having the conversation with me, if that makes sense. So West Coast has been really busy, right? So how about East Coast? One question from the East Coast, and then we'll kind of get into...
Did you find it difficult not having like that business background in college?
Thankfully, I mean, I have a decent mentor who's taught me an awful lot. And so I actually feel like I kind of hit the ground running. I took to it pretty well, and I've just always been quick on the uptake for things. I've always been a researcher, and I mean, there's just a lot of reading, a lot of studying, a lot of education you need to go through. But it wasn't overwhelming. And in fact, lots of educators go into the business because they realize it's really a lot of educating people to help them make informed decisions.
And what certifications do you have?
So I hold my PA Life Accident Health license, and I'm Series 6, Series 63 investment license. Licensed in about 5 or 6 different states.
How do you get like a client or somebody who's not a current client? How do you get them to come to like Northwestern Mutual and put their money with you, or like pay for your service? How do you convince somebody?
Say please. No, we bring value from the beginning. So like I said, Northwestern is not a transactionary-based company. So really bringing the value of a long-term relationship and showing them the long-term play and how we're not here to just sell you something and never talk to you again, which unfortunately is happening out there a lot. But we're going to catch up with you 6 months, 12 months from now, reevaluate your plan, and that's really what it is for people, because they realize Mike or Jason or Rob, they're not just a financial guy, they're my financial guy, and that's kind of when you help people realize that, it makes the transition pretty smooth. Yeah. Anything else? So we really just wanted to give kind of an overview of financial planning 101. So I'll really start with this paper, if you guys are okay with that, and then I'll turn it over to Jason to round us out this evening. So when I run personal planning analyses for my clients, the first thing that I want to do is I want to cast them out into the future to hit their furthest away goals. So do you know the number one reason why people are working with financial advisors? Just curious if you had to take a guess. Retirement plan. It's retirement plan, which makes sense because it's the furthest away goal. Complex. You gotta know a lot. You have to understand quite a bit, right? On this sheet, where do you think a ton of most Americans, the majority of Americans, if you could take a guess, are stashing their money on an on-purpose basis?
401ks.
401ks, okay. Do you guys know about 401ks, how they work?
Your employer?
Yeah, through your employer. Oftentimes there's an employer match, right? So if you're given 3%, you're getting 3%, match on that, right? If you have $1 million in your 401k, do you actually have $1 million in there? No. Why?
You gotta get taxed.
Because it's going to be taxed at your ordinary income rate at that time that you pull it out, right? So what we like to say is Easter just happened, right? So this is kind of perfect, right? So diversification, right? Not keeping all your eggs in one basket. So you obviously want to be diversified within one of your baskets, Okay? What we like to show clients is you want to be diversified among different kinds of baskets, right? Making sure that you have your 401k and your traditional IRA, which are called pre-tax accounts, pre-tax situations where you're going to be taxed. And then the nice thing about those is your contributions you can deduct, right, from typically from your bottom line for your taxes, which help you get into a lower tax bracket. And then you have a Roth IRA. Anybody know the big significant impact of a Roth IRA?
It's not necessarily taxed at the same rate.
Say again?
It's not taxed at the same rate.
Well, it's actually, so you pay tax as you go in, right, and then you never pay tax on that again. If you keep it open for 5 years, right, it's actually, the growth on that account comes out tax-free as well. Okay, so we like to show you, hey, have a chunk in your 401k, which is growing, potentially getting matched in a pre-tax. Have a chunk getting in a Roth IRA, growing tax-free, right? So you don't have to liquidate nearly as much, right? And then, anybody knowing about anything? Hey, here's how life insurance can potentially work in a retirement planning. Why would life insurance show up as a bucket here?
Pull out from it. Like,
Out of what? Out of what kind of life insurance policy? Just two big flavors. First flavor.
Whole life.
Yep. And the other one?
Term?
And term, right? So term is like renting, permanent's like owning. If your cash value that's growing in a permanent policy, you can potentially use to help supplement your retirement needs, right? Just real quick, statistics, if you guys are into numbers, 75% of the time, stock market has been up the last bunch of years while they've been tracking it, right? 75% of the time, markets have been up. What happens if in 2008 happens your very first year of retirement? The last thing you want to be doing is pulling all of your dollars out of your retirement accounts that are in the market, right? So that 25%, let's say, could be sitting in a cash value that you have access to, right? Last thing I really want to talk about is disability insurance, because, right, so we casted you out into the future, right? Retirement is way out there, let's say 65, 67, who knows what it'll be in the future. What happens in the today? What kind of planning do we need to do for you guys today? And what would you have to be mindful for your clients potentially in the future for today? What do you think the big obstacle or the thing that you would need to protect against is? Say again?
Like home insurance?
Home insurance, maybe? Say again?
Unemployment?
Unemployment, maybe? What happens if you get sick? What happens if you get hurt? You're not going back to work ever. Disability insurance. Long-term disability insurance, right? So let's say you're making $100,000, hypothetically, right? Most companies out there are giving you a 60% benefit, right? So after your long-term disability kicks in, you're making $60,000. But then you scratch your head and you say, oh my goodness, I just took a 40% pay cut, and that's potentially a taxable benefit to you. So Aiden, how would you and your family and your 3 kids do financially if Aiden takes a 50% pay cut?
Not great.
Most clients look at me and they say, no, Mike, that can't happen. So what can you do to help me?
Yeah.
Long-term disability insurance, right? So where Northwestern comes in is kind of fills the gap. We can't get you 100% covered, but so it's in your guys, and especially as the young singles, potentially young married market. When you guys get out of school, disability is a no-brainer, because if you're not working, you're not saving. If you're not saving, you're not hitting your goals, right? This is coming from a guy, my dad, cancer, bipolar 2 disorder. He's been on Social Security disability the last 15 years. Never had an individual DI policy, right? Scraping along the way, okay? Keep that in mind, guys, right? So that's kind of my portion. Is that helpful?
Yeah, absolutely.
Okay. There's a lot, right? So this is just the quick version, right? So we'd love to talk, answer any other questions.
Yeah, so what kind of software or tools do you use when you're trying to put together someone's plan?
Is it the projector?
So it's proprietary. We just call it PPA, personal planning analysis. I don't know if other companies out there are using specific
some type of
programs
planning
or
analysis.
Living balance sheet?
Yeah, I know some companies use Living Balance Sheet. Are you aware of that?
No. Living balance sheet?
Yeah, it's kind of like an online software
It's a computer
that
program.
helps them just personalize and sort all their different financial instruments.
I know a lot of people, individuals, use what's called personal capital. If you're familiar, familiar with that. That's cool. It kind of helps you get a sense of your financial picture. What's cool about Northwestern is we have Northwestern Mutual Connect, NM Connect. It's an app. If you become clients, you can access that, and it does the same thing. It's kind of like mint.com on steroids, where it just it aggregates everything for you, and you can see your insurance, what you have, investments, what you have, how much you're spending, what you're spending it on, how much you're blowing on the coffee, right?
On the investment side, Morningstar,
Right.
Oh, okay.
you know, we lease their software.
And then, so if let's say something in the economy happens, like rising interest rates, will you be on the phone with your clients right away saying, "This is what's happening. Can we adjust your plan? You know, this is what we're thinking," or do you just let it happen as the economy's going? Just not that much contact with the client.
No, I mean, we're definitely having contact with the clients on an ongoing, regular basis. And experience just shows that obviously in the volatile times, the more that we're in contact with the clients, you know what I mean, the easier the relationship is, and it's going to continue to be. As far as there's treasury and inflated protected security, so those are some things that we would incorporate into a client's portfolio now to help the impact of increasing interest rates. So the stuff that we're proactively doing right now, even before, you know what I mean?
Okay,
Swing would continue up. But again, back to Mike's point, long-term asset allocation strategy is the key. So again, if your portfolio is 80-20, 90-10, 95-5, whatever, we want to consistently rebalance back to that same portfolio.
Yeah.
Sometimes I try to make a lighthearted question, but if I say to a client that might call in nervous, I say, I'm going to ask you 3 questions. If you answer yes to any of the 3, we're going to change your investment strategy or portfolio. If you answer no to all 3, we're not doing a change. Question 1 is, did you just hit the lottery? Most of the time it's no. Question 2 is, are you retiring tomorrow?
Yeah.
You know, and again, if I did a review with them 3 months ago and they're still going to work another 15 years, that's the game plan. If they did say, you know what, I totally changed my mind, I'm retiring tomorrow, then we're going to change something. Third question is, are you having trouble sleeping at night because of your asset allocation and the market? You're so stressed that literally you can't sleep. Again, most of the time people say no to all 3, so we just stay in the box and continue what we're doing and consistently balancing. Does that answer your question?
No, yeah. And then what kind of competitive advantage does Northwestern Mutual have over any other financial planning firm?
If you look at it, it's the long-term relationships that we're building. Okay. It's the world-class products on the insurance side, which are key, which is life insurance, disability, long-term care. Okay. Northwestern is a unique company where we can sell mostly any other company.
True.
So
Yeah. Our
captive.
firms are really fixed into.
But no one else can sell Northwestern.
Yeah.
So we kind of have that open architecture platform. And then on the investment side, Northwestern Mutual does not produce or generate mutual funds. So we're not forced to sell a Northwestern mutual fund. It doesn't exist. So again, we have basically open architecture on the investment side. So it's unbiased, you know, advice that's coming to you, you know, as a client.
Yeah.
Does that answer?
No, yeah.
If you want to take, you know, a minute or 2.
I can answer a
or
question
go
about
ahead.
the internship in the meantime if you want.
Yeah, but the personality, if you want to check a couple of those boxes of the handout that I gave, which financial planning personality are you? You know, take a minute, the goal setter, the procrastinator, the dreamers, or the pretenders. Just see which one you resonate with. Mixed bag, okay.
All over the place.
Pardon?
All over the place.
All over the place, okay. So again, you see you have the goal setters there. You know, those are well-driven, self-motivated, again, know what they want. Probably, you know, do a budget on their own without me suggesting they do one. Okay, you know, those type of people, your friends.
At what point do you realize when talking to someone, like, they might have checked something off, but they're not actually that at all? When you're, like, actually talking to them once they've done the survey?
Well,
And then you kind of have to put them, like, in reality.
right, because when I go through the fact-finding process, and I find out, you know, they might say, I know what I want in the future, and I go over your 1, 3, and 5, and 10-year goals, and you're like hesitant and you have no idea. Or, you know, again, you want to retire at a certain age, at 55 or whatever, and we get to the savings point, you have $2,000. Or something like that. So then we just have to, you know, politely and delicately, you know, bring them back to reality. Again, procrastinators, you know, you have those situations and facts and figures. And then we have the dreamers, okay? And then again, we have the, you know, the pretenders. So, but again, just be conscious about how these things play into how it affects your financial future. And again, it's not just what, but why, again, we behave the way we do can help us gain new understanding. So you want to figure out why you behave the way you do and try to correct those things. And again, we'll get to it in a minute or two, but just the little steps, you know, building a budget, knowing where the money goes, creating a plan, starting to save a little bit of money, and doing some of the things that you guys have already done with your own portfolios. You know, take $50 a month, put it here, or, you know, when you get gifts or whatever the case might be, accumulate, take $500, $1,000 or whatever it is, and start to put somewhere. So, you know, you establish that. Okay. Like I said before, we all want to be smart decision makers, you know, learn quickly and choose all the right things. But the problem is, you know, we're prone to irrational and emotional thoughts and behaviors which get in the way. So in a way, I consider myself as a financial trainer, right? Because again, we either have coaches for our sports or, you know, teachers or mentors and sometimes coaches, and we have our physical trainers and things like that because they help us do things that normally we don't want to do. You know, I don't want to, when I was in college I played sports, I don't want to get up at 5 or 6 in the morning and go run. I don't want to do that, but I had a coach there, you know, yelling at me to help keep me motivated. Not that I'm yelling at clients, but we help them do things that are counterintuitive to human nature. And that's the key when it comes to investing. You know, we want to consistently rebalance back as opposed to letting it ride and letting it roll. And then what happens is your asset allocation gets out of whack over time. And then when the market drops, you drop like a ton of bricks because you hadn't rebalanced your portfolio for 2, 3, 4, 5 years. Okay. Again, basic, never too soon to start. You know, you want to have the freedom to choose. Taking simple steps will help ensure the financial health. Again, budget. There's a budget in the handout, so it's detailed, so you guys can kind of go through that to see what you're actually, what the goal of the budget is, and then to find out what you're actually spending. So again, to help identify, are you in reality or out of reality? Again, things you can put into use right now. Start saving money now. Establish, preserve good credit. Live within your means. Okay. Again, putting money in buckets. Short-term, mid-term, long-term. Really quick on that. So just again, visualize there's a 5-gallon bucket at your feet. But there's really 3 different buckets you can save money into. The first bucket is your short-term bucket. It's right beside you at the chair. And again, that's for financial goals that say 3 years down the road till retirement age. So those are non-qualified dollars. And again, there's 2 types of monies in the world, qualified and non-qualified. Qualified is any retirement account, IRA, those different types of things. Non-qualified or non-qual is anything that you can touch before 59.5 without really a penalty. Okay. So again, in that midterm bucket, you're stashing money in there for whatever the future might hold. Buy a house, get married, kids, weddings, whatever the case might be. Okay. That's a taxable account. You get a 1099 on it each year. Okay. And then we have the third bucket, which is at the end of the room, and that's really your retirement bucket. That's your age 59.5 plus bucket. And that's the buckets that Mike went over. You have your traditional IRA, 401k, and again, Roth IRA, but again, footnote, there is a caveat where we can touch the money before 59.5 without a 10% early withdrawal penalty. Okay. What Mike was alluding to is you have to keep it in there before you can really start to touch some of your growth, but you can always touch your principal at any point in time, as long as the principal's in there. So if you gave $5 grand, and it's worth $4 grand, and you need the money, you can only get $4 grand out because that's the account value. Okay, but if you gave 5 and it grew to 6, you really can get out 5 without any penalties or taxes or fees. Okay. Any questions on the 3 buckets? Short-term bucket, mid-term bucket, long-term bucket. Okay. Again, as far as a Roth IRA, just a couple quick hierarchy rules. Again, there's income limits to it, so check. Single income limits, married income limits. Again, when you're underneath the radar screen, so as soon as you get out of college, you'll be making too much more, you'll be excluded, you can't fund it. But if you are underneath that income threshold, fund the Roth IRA, because hopefully you will soon will be above the Roth IRA number, and then you won't be able to fund it anymore. So whatever you can get into it now will always continue to grow tax-free. Okay, any questions on that? So get in what you can right now. Again, we talked about the goals. Most important asset, Mike talked about that, and really that's just your health and your well-being. Okay. Again, just a quick snapshot, what you're making here at certain ages, what you accumulate over years, and your potential human value graph or worth. Okay. And I guess the point is with car insurance, we have car insurance on a depreciating asset. We have homeowners insurance on a appreciating to a certain degree asset, but this is your biggest asset. You might be driving a $4 million car someday, I don't know, but as far as the potential for growth, this is what it's about. Again, let me just get these up there. So again, upon graduating, just some insight. Most companies are either going to have a 401k, for-profit organizations, or 403b, nonprofits, or what's called a simple IRA. Most any of those are going to have some type of employee or match. So you want to at least do up to the match. A lot of times, generically, it's 50 cents on the dollar up to 6%. Generically, so you at least want to do 6%, or you're leaving free money on the table. Okay. A lot of times there's a vesting schedule, 5-year vesting schedule at 20% per year. So if you leave after 3 years, whatever they put in out of the employer's match, you take that 60%. 4 years, 80%. 5 years, you're 100% vested. Okay. There are things called target date funds. Who knows what a target date fund is? Anybody? Okay. Again, 10, 15 years ago, you would be handed a 401k lineup, and there would be 20 different funds to pick from or cherry pick. Okay. Again, what happened over time is not recently, but someone started in 1985 working at a company, had no guidance and leadership, and they either picked all company stock or they picked one mutual fund. Fast forward to 2 days before they're going to retire, and they have $1.5 million in Enron. You know what I mean? Armstrong. And that happens, and 2 days later, they're ready to retire and they have $100. Right. So what mutual fund companies did in collaboration with corporation companies really designed these target date funds. So basically there's no excuse. Target date fund, if you know how old you are and know when you're going to retire, you can do the math. So just take, usually I just take 65 minus your age and then add that to the current calendar year. So again, you guys are probably going to be in 2060, 2065 target date funds. And it's really the calendar year when you're roughly going to be closest to age 65 or 70. Okay? Yeah. It's a prepackaged asset allocation model for you. So again, if we're looking at Vanguard, T. Rowe Price, Fidelity, American Funds, BlackRock, whatever you want to call, they all have these prepackaged target date funds. So if you pick the 2060, it's going to be 85-15 or 90-10 pre-balanced for you because they have a fiduciary responsibility behind the scenes to have it balanced for you. Does that make sense?
And does that allocation adjust as you get closer to the end date?
Yeah. So again, right now today it might be 95-5. Yeah. If we looked at it 10 years from now, whatever, it's going to be 80-20. 20 years from now, it's going to be 60-40.
And what's stopping financial planners from just recommending those, or they're just going to adjust for you?
Nothing.
No.
Yeah. I mean, one word of caution. Again, there's some articles recently written about it. Some of these fund families, it's called their dog funds. They're going to put their funds in there in the pre-package that you and I normally on the street are not going to buy. Okay, so it's a way for some of their underperforming or lower asset balanced funds to have money coming into those funds and a captive audience for that fund manager, frankly, to get new assets and to invest. So that just be a little bit of a word of wisdom and caution. That's something you want to kind of look into an X-ray in that prepackaged fund, what are the 17 or 25 funds on an individual basis? Are they, the fund family's really good funds? Average, mediocre, below average? Does that give us some insight? But again, 90% of how well you're going to do is having the right asset allocation. And that's 90% of the game. So if you really did pick a target date fund that's going to keep you balanced, I think that's important. It has some value, you know, above and beyond if the funds are average, you know, as opposed to letting it up to trying to time the market. Again, it's not time in the market, but time in the market. So again, you guys have 40, 50 years or whatever the case may be. You know, am I right? Time in the market versus time in the market. Those little stress off you. Any questions about retirement plans at work or anything like that?
All right, so I was thinking about opening up a retirement fund. I already have a brokerage account. So what would be the benefits besides me not being able to pull out the money just for starting a retirement fund? Because I'm worried that maybe I'll need the money in some time of my life, and like I won't be able to access it without penalty.
Well, again, that's where the Roth IRA would come in. You know, so in your definition of a brokerage account, it's a non-qualified. It's in your name, and you get a 1099 each year. Okay, which is fine, and there's advantages to that account and structure, just like there's advantages to a Roth IRA. Again, the one unique feature of Roth IRA is you put in $5,500 today for 2018, and an emergency happens 6 months down the road. Assuming that you had some growth, you could at least take out $5,500. Okay. But you're getting into a tax-free environment, right? So again, if I'm sitting down with you 5 years from now and you have $100,000 in a non-qualified account, I'd probably be talking about repositioning some of those assets over to a Roth IRA, right? Not eating into your cash flow, right? Because you graduated or whatever, and you have other goals and aspirations you want to save money for, and the Roth isn't on the radar screen, but we could just reposition some of those assets from this account over to this account. Is that?
Yeah, no, that's clear.
Yeah.
Just open up a Roth IRA.
Brokerage versus advisory, just again, some quick insight into that. As far as establishing or building relationships with an advisor, so brokerage relationship, really fiduciary responsibility is suitable at the point of sale. So, you know, usually there's some type of commissions or sales charge or something along those lines in that environment. Usually it's transactional based. And again, the negative connotations in the industry could be you per se sell someone something, you get paid a commission, and you never talk to the person again. You know, that's a negative connotation to that, okay? But that's just the pure nature of it. It's a brokered relationship, fiduciary responsibility basically suitable at the point of sale. And again, usually you're picking, let's say, one fund family to work with or to invest with. And usually, and again, a brokerage, there's a commission or sales charge. And then you're picking either A shares or C shares. A is an apple or C is in Charlie. Who knows about A and C shares? Anybody? So, A share, there's an upfront sales charge. The more money you have with the fund family, the lower your sales charge is, and it's called hitting a break point. Okay, so again, generically, a lot of fund families, $0 to $25,000 of assets you have with them, it's going to be a sales charge of whatever. 25 to 50 if you have with them, it's a lower sales charge. 50 to 100, it's a lower sales charge. 100 to 250, lower. 250 to 500, lower. 500 to 750, lower. And then 750 a million, 1% or whatever it is. And then usually, a lot of fund families, if you come to them with $1 million, you're buying it, then it's a value. They waive all the sales charges. Okay? So A share, you pay an upfront sales charge or an entrance fee. It becomes lower the more money you have with a fund family. Okay? And then your annual expense ratio is going to be lower. Okay, annual expense ratio is what the mutual fund companies charge you to keep the lights on. All right, so A share, you pay an entrance fee, low annual expense ratio, no fee to get out, no penalty, no charge. Okay, no contingent deferred sales charge, CDSC. C shares, C is in Charlie, no upfront charge. So put in 10 grand, you see 10 grand show up. Put in 100,000, you see 100,000 show up. You as a consumer feel warm and fuzzy. But the trade-off is your annual expense ratio is usually going to be twice that of the A share. Okay, so the A share is 0.75, Annual expense ratio, C share 1.5%, 2%, something along those lines. C share, again, if you want to get out in the first 12 months, there's going to be a 1% contingent for a sales charge. Okay. You can always look at mutual fund prospectus, and it shows you investing, and again, industry standard, invest $10,000, assuming a 5% rate of return, and you hold the fund for 1 year, 3 years, 5 years, 10 years. And it shows A shares versus C shares when you pay the total fees. So it's trying to show you the crystal ball. Again, generally speaking, C shares are more efficient for a short-term horizon. Again, don't hold me exactly to it, but let's say give or take 5 or 6 years or less. C shares more efficient. A shares become more efficient the longer we have them around. Okay. A shares are even more efficient if you hit a break point and have a reduced sales charge.
When is like the typical like optimal point or like the reflection point when it changes?
6.
Is it 6 years?
Yeah, again, give or take that 5 or 6 year range. But definitely at 10 years, the A shares are going to be more efficient on a straight generic investing 10 grand, paying a max sales charge, assuming a 5% rate of return. Okay. Advisor, so brokerage, sales charge, commission, A shares, C shares. Okay. The other types of relationship you can establish someone an advisory relationship. Advisory relationship, just kind of like it says, you're paying for advice. You're paying for ongoing advice and services. There's an ongoing fiduciary responsibility as long as the client wants to have a relationship with you. Okay, so again, if you're the advisor, they can leave, they can end the relationship whenever. Okay. In that case scenario, usually the whole Universal Mutual Fund is open in that portfolio, and we're able to go out and get best of breed. So we're able to go out and shop the whole universe. You know, behind the scenes, NIMIS, Northwestern Mutual Investment Services, who's our broker-dealer, has hired Morningstar Institutional on the research side to research every single mutual fund out there, stock, bond, and so on and so forth. And then again, critique them and look at them on a daily basis and test them at 8 different criteria daily. Fees and expenses, tenure of the manager, performance, style drift, so on and so forth. So,
well, then would the management fee or the annual management fee be higher because you're getting that more personal advice?
well, yeah, any advisory, that's where there's no sales charge commission. The advisor is charging a certain percent per year to run the money.
Yeah. Okay.
So the more more an advisor runs, the lower that fee usually is.
Yeah.
Okay, and again, in the industry, that fee could range from 0.5% to 2%. Okay, again, depending on what company, what advisory, the amount of the balance of the portfolio. Okay, so again, advisory, ongoing fiduciary responsibility, stay in contact with the client, whole universe of mutual funds to pick from, no sales charges. Usually you're buying institutional share class. Okay, any questions on advisory? And usually there is a minimum account balance. Okay. So again, we're not doing advisory for a Roth IRA at $5,500. You know, that's going to just stay brokerage. Okay. 50 to 100 minimum. You know what I mean? Upward is more at the advisory level. Okay. Any questions on brokerage versus advisory?
Which one do you recommend?
I explain both to a client. Who asked that question?
Oh,
okay. I explain both to a client. You know, it depends on what the real client's personality is. You know, some of my Wall Street clients, they like the brokerage because it's cheap, it's efficient. They have $1 million. They can go to a fund family like American Funds and buy it at net asset value, and they know American Funds and Cap Research, and they're happy with that. You know, I have another client might like the transparency of the advisory, where they don't want to pay a sales charge commission. They basically want to lease or get professional advice on a quarterly basis, because if you're charging someone 1% per year, it's just broken down, a quarter each quarter. So in a rudimentary fashion, I just say you're really leasing our services on a quarter by quarter basis. Take the relationship from there. I would say most clients that have enough money to go advisory, when given the two options, a large majority go the advisory route versus the brokerage, because they like oversight
what they're doing as well, yeah.
and the fiduciary. And again, the Department of Labor government just came out June of last year and basically said that advisory is more or less the way to go. Okay. And that's something we have to, when a client comes on board right now, we have to, and that's just a new document, to fill out as of last year, you check the box. Do you want to have a brokerage relationship where the person gets paid a commission and a sales charge with no ongoing advice? Check that box. Or check the box, do you want ongoing advice and a fiduciary responsibility and relationship? And the client needs to answer that box, as part of the application process. Again, leverage company benefits. Just again, a couple quick takeaways. Do the 401k, 403b, do the match. If a company says, hey, you get 50% of your group disability insurance for free, do you want to sign up for the extra 10%? Please sign up for the extra 10% for $1 a month, please. Okay? Like, those are things you want to leverage and take advantage of. Okay? If a company says, hey, you get 1 or 2 times your base salary for life insurance, cool, take it if it's free. If they say, hey, you can buy additional coverage, normally Rob and I can get it to you for the same price or a little bit cheaper on the outside coverage, and here's the reason why. When you're paying the group rate, you're paying the same rate as your buddy down the hall that's diabetic, overweight smoker. That's a great deal for him or her. Right? So if I'm meeting someone and they're a smoker, they don't have the best health, I encourage them to get as much life insurance through work as you can, because it's a great deal. But if you're normally pretty healthy, we can get it outside. And also when you get it outside, it's portable. That coverage you signed up for work, when you leave,
It comes in. It doesn't come with you when you're at work, yeah.
right, it stays behind. So, you could have $500, $1 million of coverage. You have it bought through work, you leave that job, that coverage stays behind, your health changes, and you can't get any more of those problems. Okay.